Good morning. We've had a good couple of hours of sitting around and talking about the markets, talking about worldwide financials. What do the financials really mean? Is that financial systems are financial systems. We have a U.S. financial system, we have a Chinese financial system, we have a Rio financial system, we have a Europe financial. We even have an Italy, Portugal, Spain, Ireland, and Greece financial system. Think of that. Now, one of the things that we're going to talk about here today is what is going to be the key metric highs and why does volatility, extreme volatility, as we said, stockmarketfunding.com was very happy to tell the people that may or may not view our live analysis, it's okay. What we do is for MMTs. We don't do it for the general public. But if the general public was paying attention, then they would know how accurate it was. Because the proof is there. The analysis before the fact is there. That's the key metric of how our lives should be loved. Loved and lived. Live and love. And when you get into financial markets, is that history has a way of repeating itself as we understand it. And the amount of stimuluses and the amount of turmoil around the world is quite evident. It never left. What happened over here in 2008 in our financial systems, that's never left. That problem is still here. And people are not willing to come to the conclusion that that problem is still here. And yeah, it's not a good thing, but however, that over the period of time is that this whole downside move at some point, whether it's in 2012 or 13, it doesn't matter what calendar year it is. What does matter, though, that the next leg, there is a consequence behavior or behavioral consequences that what happened over here is going to repeat itself in the financial system around the world. And where does it always start? We did a very thorough analysis starting in 1825 up to our current life cycle today. What we have found out is the repetitive or the consistency of prior behavioral patterns in financial systems around the world is that they play their roles again. And we certainly did here. And what we're doing here now is that price volatility and the amount of extremes that are going on in the current environment that we live in increase. They progress. We know that the progression leads to an event. Rather, it's the upside event, because this was this expansion. And it's the same type of expansions that have happened over here in 1996. Look at here. That was an expansion. It failed miserably. The 2003 to the 2007, it was an expansion, economic expansion. It was a financial system expansion, and it repeated itself, but it failed miserably. They all do. And what do I mean by that bold statement? Well, the proof is here. The proof is here. What was happening here in this great monthly movement, this is a 200-month chart, it's a monthly movement compounded by years, is that it failed. Back to here. Didn't matter. It's what they did. It's how they were operating in the financial system, but it failed. It's here. It failed. I'm sorry. They all do. What I'm saying over here is that the 2003 wars that were created, and that this whole thing from 2000 all the way down failed miserably back to the 1997 breakout and the 1996 bottoms that were put in over here, is that they all failed, and they failed even worse here. You went clear back, so you went from 2009 back to 1996, where it started in this particular time cycle, market cycle, financial capitalism around the world as we understand it. Okay, everyone's got an opinion, but I can tell you what, ours have been right. And what I'm telling people now, whether it's 2012 or 2013, whatever the case is, what I'm telling you is that this move here, the next leg that's coming, I didn't say that's coming Monday. I didn't say it was coming August. Today is 7/23/2011. I'm not saying that this event comes next week or next month. It will come in its own natural time cycle. Right now, we have a very bullish, and the only time that they lever up, you have to know when to be a, well, it's not that we're a bull and bear, but you have to know when that things are going to change and how cycles work, but they all fail. And we're going to come up here, and I said that when we put the bottom in here, that for the bull part of 2011 is that you got a rising 10-month moving average on the S&P. And what does that mean? That means that in this particular cycle of time, that this is very strong for now. And everything that they're doing in stimuluses in financial markets around the world and leveraging debt, making more debt, has a consequence to it, just like this consequence was here. So the bullish thing about it is that you go back up toward the high side over here. The year-end analysis on the S&P, it would be not abnormal to see it come right there. That's 1467 on the S&P. And we already know it. And the thing about it is, though, that there's this certain kind of contagion, though, that's been brewing for a long time throughout this whole expansion. This is all your stimuluses right here. This is everything at the tail end of the Bush administration into the Obama administration. And the thing about it is, though, the amount of manipulation and corruption that takes place in financial markets around the world, it's always that. They're always manipulating. There's always much more degree of corruption that goes on in the financial markets around the world than good. And that means that we have levered up here, and we have levered up here. Okay, so you went down, and on a monthly chart you come back up. But these are all stimuluses, and the bond market's not going to be wrong. Moving forward, it's very important that people should learn, even if you don't trade the market or invest in the market, you should learn about the bond market, though, as a reference, that the bond market has a way of pricing events forward-looking before they actually happen. And that the Federal Reserve Chairman, Mr. Bernanke, in this case, is not going to beat the bond market. No matter how much you want to manipulate in the short term or stimulate in the short term, and all of these things that occur fail. I didn't say they're failing next month. What I am saying is to be quite aware of it. And right now, as you live in your life, and if you're involved in the markets, today is 7/23/2011. But what about a forward-looking year from now? The only thing that's going to change when that date does, it'll be 8/23 of 2012, a year from now. And what are you going to do between now and then? And how are you going to be aware of the warning signs that will happen? And that time cycle is a time cycle. So when certain kind of key metric financial events are happening around the world, and various different central bankers around the world, and different parts of emerging markets around the world, within that whole big capital system that we have, that is a global thing these days, is that they're going to fail. And the thing about it is, the U.S. bond market is always going to be a key catalyst to that. And when one is educated properly, they will know. And we haven't seen a Federal Reserve governor year to date, since its inception of the Federal Reserve, that they've beaten it, because they haven't. Not one. Not one person. Not one. Since its existence, when it was in the early 1900s, when the Federal Reserve was designed to do what it does, is that it's supposed to be biased to Wall Street, and it's supposed to be biased to everything. And it's supposed to be a mechanism that was originally created to try to help preserve U.S. capital wealth and protect U.S. citizens. We don't have that today, folks. Because we don't. We're in the July earnings right now of calendar year 2011. And we have a very bullish tone to a double year breakout pattern that happened at the bottom of 2010 into 2011. You can see up here on these very monthly bars in the S&P where every dip was bought. There is a, as far as standard technical analysis goes, you got a rising 10-month moving average above 100-month. All of this is very bullish. What was very bearish is when we hit that monthly sell signal, and these only come around every 4 or 5 years, and we've been in a monthly buy signal. 1, 2, 3, 4, 5, 6, 7. Draw a trend line. What is the blue bars? Moving average convergence divergence. This is standard technical analysis. Now, that's where the broader part of the public is liking it, because you see, we're going to peak here, and in this current monthly cycle, at the high of the percent DS, we were right around 93%. And when I gave every one of these corrections within the bull rally, stimulus bull rally is what I call it, is we've sharply rebounded, because we have. And for 2009 and 10, of course, we have all of our work that we called that bottom there. Today, we have things like live analysis that, you know, people can pay attention to and follow. So we have a very bullish move on the monthly buy signals up here. That's why every one of the dips are viable. Okay? Because the longer that it goes in the calendar year, the stronger the dip when they come down and correct from overbought processes. This one here, we called it right at the very top. You can go to stockmarketpundit.com, and I talked about how the S&P was going to come all the way down, and it did for 2 months right here. Go stockmarketpundit.com. There's a search box there. Put in Dow Jones indexes, or S&P, whatever the indexes were, and go back to these dates prior to 5/1. I said there was a correction coming around the corner. Within this long-term bull rally, that we've enjoyed. But we also know that forward looking, that we're going to have another event. And that financial systems are leveraged up, stimulated up, manipulated up. But why do they fail? Well, everything I just said. They're manipulated, they're stimulated. At whose expense? In this case, it's the U.S. citizens, because we're looking at the U.S. Markets right here on a monthly level, where we have these breakouts and these pullbacks back here in 2010. And basically, the same contagion that was here at that time has also been very evident here. But what makes it different on a monthly level is that we weren't going to go lower here. And it's a very monthly bullish chart. But why will it fail? At some point. Whether that's 2012, 13. But it's coming in those periods, is what I'm saying. Right now, we're taking advantage of how markets have re-leveraged themselves from the deleveraging process back up. And why is it going to fail? They all fail. There's not one that doesn't. I can prove it. I already have proved it. And how are you going to plan for it? And what does that look like in your life? That's the important thing. If you're involved in capitalism, you're involved in financial markets, the risks are higher than any other period of time in history right now, in my view. Having said that, is that because of that risk is higher than any other time, is that eventually there's a consequence to that risk. When we look at where the neckline was, we take a look at this piece of the chart, and we take a look over here where that downtrend started in 2008, and the top of that was the first bout. Then, of course, you manipulated it up, and then, oh my goodness sakes, the truth had caught up. And basically, the bull, what it says on the chart is extremely bullish. And we can see that on the S&P that the last highs were right around 1370. But look at the double month correction. And when we hit that 10-month moving average, we bounce like a rocket. There's a lot of uncertainty around the world right now. Yeah, earnings are good. The stimulus has been working. All of those things have been working. But there's a consequence. And there's a failure point at some point. And as we take them up, the thing that we're really monitoring in this calendar year of 2011 was that each big sell-off that we called for, this one here, and down to the bottoms right here, is that because of the monthly buy signals, is where every dip will be bought in the cycle. Because you can't ignore that. I can say, though, that we're at 91.66% DS on a monthly level on the S&P. And that we could easily break above here. Now, I'm going to go to the SMF platform. And I'm going to pull up a daily chart in our platform. And I can get where the S&P is going to go. We're right back up here. So it's much more visible and an easier way to comprehend. And the thing about the S&P was that we called for a rally that could go up to 1360. That's two full deltas. We're 18.30 from hitting that price to delta right now in our system. And when we get up there, what's going to happen is we're going to be extremely overbought on the S&P. Again, just like we were when May started. However, we could fail if the United States government doesn't know how to work its system correctly, is that these things can fail. And we can see over here at 1365 where that failure was. We called it right here. That was on 5-2. Look at how far down it went. Look at how far it's come back up. There's mathematical negative consequences this way, and there's positive mathematical outcomes that happen this way. But when we do finally reach our destination, what is going to happen then? We're going to sell off. I'm telling you today on 7/23 of 2011 that the S&P 500, as it levers itself back up, and it's bullish chart patterns. I just showed you behind here what this one looks like. That's okay. I'm just interpreting that for standard public technical analysis. Over here, though, is the SMF platform. And what does the platform really say? Is that every indicator that is over here and what is happening is built in here. This platform. And makes it easy for people to understand. What's going to happen is, as we lever back up, we said 1360 on the S&P from this bottom here, this last bottom right here, which was just not too far ago. It was only 1, 2, 3, 4. Today, that's 5 days. The last 5-day trading range is that we got overbought and we came down, like I said, and then we've come right back up to where that reversal happened right here. And when I look at our system, when we do get here, it's time to be looking at this side of the market. And what is this side of the market? Well, short term, long term. Long term could be going out a long ways. I mean, we could go out to 2013, the end in calendar year. We can go out to 2013 here, but we can also go to 2012 here. And when we look at short-term imbalances, mathematical imbalances of overbought and oversold conditions, is that we certainly have to take in relevancy where these things are going to go. And what does this side of the market look like? The call side. But then, what does the put side look like? And here are various strike prices. So when we take a look at shorter term cycles, such as August and September, as we take a look at where the capital markets are, and they're bullish. They have been in an expansion cycle, as I said over here. None of these expansion cycles, and you're living in one right now, this one is current, these were also ones that you may have been involved in your lifetime, that everything looked good over here in the Bush administration. And that all failed. Back over here, the times were good. We came off of horrendous capitalism. Horrendous capitalism. Wow, what does that mean? Horrendous. Well, think about 1990 to 1996. Think about what was happening then. We finally got to the bottom, but it collapsed. It ended back where it all started. History repeated itself so mathematically, and so failure as it always does. You cannot hold the value when we get up here. We're going to break higher, and we're going to hit a certain plateau, as we always do. Short-term corrections is what they are in bull rallies. But when we look forward, looking out, is where does that next bear come into? So everything that governments are doing around the world is there's a consequence. And why is this 2-year expansion? 2009, 2010, and so far half of 2011. It's all part of the expansion. Just like it was over here in 2003. But they all failed. Now, what happens with the public is that they're not willing to deal with it because it's a hard thing to imagine that that's going to happen. What we're going to do is we're going to take that S&P 500 bull rally up to its top. There's a big obstacle. We know that the debt ceiling, we know that the manipulation there and all of this downgrade and our U.S. capitalism as we know it by Moody's and S&P. We also know that whether we pay our bills in the U.S. or not, we're going to pay them. They have to. However, the outcome is going to be different. And as we rally up to the tops of the S&P between now and year end of calendar 2011, is that if they do in the short term to stop those things, then of course we're going to rally back up. And we've been saying this about rallies all the way from the very bottom over here in 2009. We've been talking about this. We've been actually trading it, but we're going to rally up and then it's going to fail. We're in a very long monthly buy signal on the S&P. That's why every dip is buyable. When you're in a sell signal, and the sell signals are that MACD reading, it's a public indicator, they only come around so often. Here, back in 96, you had a monthly buy signal. Look at it, lasted all the way up until the top of this area in 2000. But then look at the monthly sell signal. The markets moved way down before they were actually created. Where in our system today, what we use in our system right here is that it tells us right away when these changes like this are happening. Okay, and this is a daily S&P 500, and when to go long here. And the thing about it is that's how markets are. And everybody wants a great outcome, except I don't see that. I don't see a great outcome when it's all said and done. And we're going to come back up here and we're going to challenge these highs. And in our system, when we take a look at the S&P, the monthly, our daily half bar is 1336. You can see how that dip came down and they came right back in up toward these tops. Now, when we look into our system, one thing that we're going to look at right now is how tops can play themselves out again. And when you take that top reversal and this top down reversal and this leverage up rally was great coming off that bottom, was also great going down, is that when we do get back up here in these areas, so let's take a look at it more in depth. Here you can see on a standard chart what it looks like is that we're going to have a big short that will come into play, and another one of these downside moves. And here's your upside rally, and it was much shorter in time than the longer correction that we called for here. S&P 500 is a special to know that you need to follow what we have to say, not because we're better than anyone else, but we're accurate. And when we come back up here to that 1360 area in the S&P or slightly below it, we're going to be extremely overbought in a shorter term cycle. What does that look like? Right now, I show you here that you are 91%. That's a extreme bull on a monthly chart. As far as the strength of overbought, when we were overbought here, we're at 93.77, and I said we were coming down, and we did. And we got to the low point here. Like I said, the low point here, it wasn't much of a correction, for crying out loud, on a monthly chart. We've been elevated in an overbought zone in the whole calendar year of 2011. Mathematically, we have. And that means at some point there's going to be a major change. That change could happen right away, depending on what your government does for you. Okay? And how capitalism around the world is going to play. And why is the bond market the king forward looking? It is. I'm not going to go into the bond market. I'm just telling you. We're going to rally up and we're going to have another correction. We had 2 months of it right here in calendar 2011. That means that when we do come up, we're going to hit the wall of resistance. Right below 1400 is where we're going to be looking at. We're going to be looking at that 1360 that we called for because the earnings season wasn't going to be a collapse. It's just all about, where's bottom line and top line growth. And this video is getting kind of long, so I'm going to have to conclude this at another date. But we're going to rally up, we're going to hit it, and we're going to reverse. And the next reversal that happens in 2011, as it will be greater reversal than this last 2-month reversal. This is how it starts. Then you come back up. This is the neckline, right below, way up here at 1399, 1467. 1450 could hit by year end, by calendar month of December 2011. If things went right, that's where the top end would go. But then again, if things don't go right, as they normally don't do, at some point they're not going to be right. So we're looking at how we bull rally up, but then when we get the next correction, it's going to be greater than this last correction right here. Okay? And we've had a couple of them. Big dip, big 2-month reversal, rising 10-month, bullish. Nothing bearish about it. However, as we lever back up, we're going to have another big pullback. Stay tuned.